Okay, let's just dive right into this explainer. I want you to imagine two friends. They both take 10 grand, $10,000, and they invest that exact same amount in the stock market, literally on the exact same day, right? So they're starting at the exact same starting line. But fast forward 5 years later, and their financial lives are completely, drastically different. $80,000. No joke, that is what one of those friends miraculously ended up with after just 5 years. That original 10 grand just compounded beautifully, but the other friend lost almost the whole thing. Now, you might be wondering, did the wealthy friend have some kind of secret insider information? Nope, not at all. The real truth just comes down to behavioral psychology, basically how they think and how they react. So in this explainer, we're going to break down exactly why their paths diverge so wildly. Look, there's no magic crystal ball here. It all boils down to the rich investor's mindset versus the broke investor's mindset. And by understanding these core behavioral differences we're covering today, you'll be able to figure out exactly which path you're currently walking on and, more importantly, how to course correct if you need to.
All right, let's get right into Section 1, A Tale of Two Investors.
So, meet Ali and Bilal. They're both 25, they earn the exact same salary, and they both decide, hey, I want to build wealth in the stock market. They even buy almost the exact same companies. And at first, man, everything goes incredibly well. It feels like a total breeze. But it's how they react when the wind suddenly changes that completely separates them. You see, Ali relies on a highly disciplined holding strategy, while Bilal falls face first into a panic selling reaction. This dynamic is perfectly captured when we look at their timeline. They make their initial investment, and boom, the market rises by 15%. Ali's up 15%, Bilal's up 15%, and they both feel like absolute geniuses, right? Investing just feels effortless. But then, bam! The market suddenly crashes by 30%. The news channels are screaming about a stock market collapse, social media is yelling to sell before it's too late, and Bilal completely panics. He liquidates every single stock he owns just to salvage whatever's left. Now, Ali was scared too. I mean, he's human after all. But while the news screamed about a total collapse and Bilal terrifiedly sold everything, Ali held on. He didn't sell a single share. Why? Because he remembered this one totally crucial rule. The market goes up and down, but good businesses grow over time. He completely understood that this was just a temporary storm. And honestly, this single decision to just hold his investments, that changed his financial future forever.
Which brings us to Section 2, the emotional roller coaster.
Investing has this funny way of forcing us into two incredibly dangerous states of mind. When prices are shooting up, people get so greedy. Everyone's like, oh, this stock is going to double. And they just buy blindly without a shred of research, totally driven by FOMO. But then the exact second prices fall, those exact same people become absolutely terrified. Extreme fear takes over and they sell at literally the worst possible time. When prices are rock bottom, they buy high, they sell low, which, is the exact opposite of what you actually want to do to build wealth. Think about a supermarket for a second. If your absolute favorite smartphone suddenly gets a massive 30% discount, you'd be thrilled. You'd rush right to the store to buy it because, hey, it's a steal. So why on earth do people run away when shares of amazing businesses do the exact same thing? Successful investors know that temporary price drops don't mean a business is suddenly broken. Actually, scratch that. It's more like they realize these drops create incredible opportunities to buy more at a huge discount if you actually have the patience to see it through.
Let's move right into Section 3, the power of time.
So while Bilal was busy freaking out, Ali just completely ignored the daily market noise. Instead, he practiced consistency. And that just means investing steadily every single month, whether the overall market is riding high or sitting low. Ali just kept buying. He did this because historical data proves, time and time again, that quality companies grow over long periods, even if their prices are bouncing all over the place in the short term. He literally took his emotions completely out of the equation. It's kind of like planting a tree. In year one, you plant the seed. Now, you wouldn't march out to your yard and dig up that tree every single week just to check if the roots are growing, right? No way, that would destroy the poor thing. In year 3, you just water it and you wait. Investing works the exact same way. By year 5, you actually get to step back and enjoy the compound growth. Time is just far more powerful than timing. While Bilal kept wildly jumping in and out of stocks, trying to perfectly time the market, Ali just casually watered his tree, let compound growth do all the heavy lifting, and watched his portfolio get stronger and stronger year after year. Moving on to Section 4, managing your risk. Imagine another investor who takes every single dollar they have and dumps it into one single company. Literally everything is riding on that one stock. If that company goes under, poof, All their money just vanishes into thin air. Well, Ollie avoids this catastrophic mistake by using diversification. This just means creating multiple safety nets by investing across completely different companies and different sectors. Look, no investment is 100% risk-free, but spreading your capital around like that massively softens the blow if one particular company has a bad year. You're not trying to impossibly eliminate risk, you're just intelligently managing it. In practice, a healthy, diversified portfolio looks a bit like this. Instead of betting the whole house on one thing, you have your capital spread safely across multiple different sectors. You've got a slice for technology, maybe a slice for healthcare, some sitting in banking, and some in consumer goods. That way, if the tech sector takes a temporary nosedive, your healthcare and consumer goods allocations are right there to keep your portfolio balanced and afloat. It's basically the ultimate safety net for your hard-earned money.
Which naturally leads us to Section 5, avoiding beginner mistakes. Let's rapidly break down the biggest missteps that routinely absolutely wipe out inexperienced portfolios. Most beginners buy simply because everyone else is buying. Pure herd mentality. They try to get rich overnight, which, let's be real, almost always ends in tears. They drive themselves crazy, checking prices on their phones every single hour. They gamble using money they actually need to pay their rent. They completely ignore doing any actual research, and honestly, worst of all, they base their entire financial future on following random, unverified social media tips.
Your decisions will immediately, and I mean immediately, improve the very second you realize the stock market is not a casino. You are not just placing bets on a roulette wheel. When you buy a stock, you are buying actual, real ownership in a functioning business. The more knowledge you have about those businesses, and the more you treat them like a long-term partnership rather than a quick lottery ticket, the drastically better your outcomes are going to be.
So when we look back at the wildly different outcomes of our two friends, the main takeaway is pretty glaringly obvious. Like, why do some people get wealthy from stocks while others lose their shirts? It isn't luck. It's not secret tips. It's definitely not having a crystal ball to predict the future. The difference is entirely in their mindset. Successful investors just stay calm during crashes, they think long-term, they diversify, and they absolutely never let fear or greed run the show. Ultimately, the market will always reward patience far more often than it ever rewards panic.
Which brings us to the most important part of this whole explainer. Before you go out and invest your very next dollar, I want you to take a step back and ask yourself this one final provocative question. Am I investing with emotions or with a plan? Because honestly, the answer to that question is going to decide exactly which path your financial future will follow. Make sure you choose the right one. Thanks for joining me on this explainer, and keep learning.